Hey, good morning. Happy Friday, everybody. Welcome in to this week's long-form episode on Mining Stock Daily. I'm your host, Trevor Hall, back home from a quick trip to the European Gold Forum, where we covered a number of new companies over the last few days, and we're not done airing those corporate updates and introductions as well. Early next week, we will continue with those and probably round those up on Monday or Tuesday. And for this long forum, we welcome in two guests, actually. The first one is Dave Lotan, no stranger to the junior mining sector. He's a private investor and also sits in on a number of boards within the junior industry. And we talked to him about really the breadth of what's happening in junior mining, who's winning, who's losing, given these new all-time highs in the gold price and also the rest of the metals moving. So obviously always a great conversation with our friend Dave Lotan. And then we welcome in a new guest, Charlie Ashbourne from Edison Group. And the focus is really on this recent move in gold. There's a lot of tailwinds to gold, but what are its headwinds? And we talk about that and really the macro fundamentals of what's driving the gold price and also the gold miners. So it's a great conversation with Charlie Ashbourne as well. Special thank you to Fireweed Metals, Victoria Gold, Arizona Sonoran Copper, and also Visa Silver for their continued support of Mining Stock Daily. There's no video on these episodes, as I was just recording the audio throughout the week in Zurich, so be patient with those. If you are listening on YouTube, anywhere else, you can find it on the podcast networks. All right, everybody, let's jump into my conversations. Have a wonderful weekend. Be well. All right, here's somebody I actually didn't expect to be able to chat with this week because I figured he was going to be stuck with lawyers and in his office and all that. But I'm happy to stand here with Dave Lotan, private investor and also involved in many junior exploration companies, including Orion Resources. Unfortunately, I have promised Dave I will not ask him about the recent developments with Orion. Obviously, we will leave that with him, the lawyers, and all parties involved. So I apologize for those who are going to be very disappointed. But David, good morning.
Good morning, Trevor.
So let's have some general market sentiment. I mean, meaningful shift in sentiment, prices, valuations over the last, say, 3 weeks. We're sitting at $2,370 per ounce of gold. Huge move here, almost dangerously too much, it seems like. It happened so quick. How are you watching this whole thing play out in the markets when you're not just bombarded with conversations and paperwork and lawyers?
Yeah. Well, it's welcome, I think, and surely now with a $300 or $350 move in the gold price so quickly, costs haven't followed. And I think that's been the problem in the market since COVID. And you'll recall that we had a big move in gold after the initial sell-off in all assets during COVID. And oil prices were greatly depressed for a while. And maybe there was a quarter or two of really good cash flow at the gold producers. But very quickly, margins were eaten up by inflation in labor costs, inflation in construction costs, inflation in reagent costs, and the experience over the last couple of years was a rising gold price and costs rising faster if you included construction costs and sustaining capital. So I can't see any place on the cost side of the business that has moved at all with this $300 spike in the gold price. And so that's the thing that always gets, for instance, the juniors moving. Yeah. Once the producers have a lot of cash flow and have some leeway to address their growth and pipeline issues, that gives you the baseline capital that you need to get funding down to the juniors.
So this conference is really focused on those big producers, right? And
it is.
For as much, I guess, constructive criticism they've received throughout, let's say, the last year because of those inflationary pressures, the cost of producing 1 ounce of gold. You can look back in the last 3 or 4 months and say maybe they're making headway into kind of controlling those costs. Mm-hmm. Obviously, the Newmont Newcrest deal goes through. Newmont says they're going to try to get about 6 big projects of theirs off their books, divest from those.
Sure.
You're seeing AngloGold Ashanti put up a just monster resource in Nevada, largest resource in Nevada in, I don't know, decades, 40 years maybe.
Yeah.
And then IM Gold, a company that is was left for dead for a couple of years ago. Now with the Cote project on their books, and looks really, really good for them to improve their financials. So, there's good things happening here. Are we have the majors done enough to kind of get themselves out of that rut from the last 2 years?
No, I think that gluing major gold companies together generally results in large production profiles that decline more quickly, and Barrick is the best example of that. And despite the fact that they decided they wouldn't buy a Great Bear, and they haven't bought a gold project of merit in years, and I think Mark Bristow's focus has been on making new discoveries in Nevada, and not buying juniors. Despite all of that, the big discovery in Nevada was made by Anglo. And who would have expected 20 million ounces at Silicon? Of course, we're not there yet, but I think that's inevitably where it's headed. And who would have expected that in the Walker Lane? So that's a great setup for the mid-tier producers and the smaller companies. Newmont buying Newcrest, again, creates the same condition in my mind, a big but declining production profile. And so those companies, which I would call the beta in the sector, and I call them beta because, of course, the whole investment world has moved to passive, and passive vehicles are just dumb entities that buy things that are big and that trade a lot of volume. So by definition, Newmont and Barrick are the companies that make up the bulk of all of the ETF product. So they're the beta in the sector, and the beta has been the problem. There's been almost no alpha in the sector other than in exploration, and that's still been relatively sparse. So the market is hungry for new discoveries. The market is hungry for new opportunities. It's inevitably going to come out of that giant steaming pile of effluence in the junior markets. Who knows who's going to get lucky here? And there's some fantastic companies in progress, the Liberty Golds of the world, great-looking projects, and I think that as the skies clear and generalists start to creep back into the market, there'll be money for the development stories. And that's really been the hole in the capital stack for the past couple of years. It's very, very tough to see how companies with large capital needs in development and far from producing revenue or how they're going to get that money. But with this $100 million deal by i-80 Gold, infuriating investors because they just raised a few months ago at maybe $1.85, I think. But that's a great sign for the market. That i-80 can go back to market and raise $100 million, I think, is fantastic. And that will bode well for the Liberty Golds and the Integras and some of the other really good and very low-priced assets in the development pipeline. And they're needed by the big companies.
The alpha in the mid-tiers right now. I mean, we're seeing a lot, like the Equinox's Greenstone project is moving along really nicely. We've seen that news. Caliber buying Marathon Gold and getting Valentine. Construction continues to improve. We just had a conversation with Ryan King earlier this week. I mean, talk to us about it. It seems like there's going to be if this market continues, excuse me, there's going to be an incredible amount of torque and alpha in the mid-tiers. Do you agree with that?
I do. And I think you've already seen it. I mean, the last time I checked the Pan American Silver chart, I think they're up 50% in the past 2 months. Caliber buying Marathon, a troubled project and a project that the market is still equivocating on, and yet able to raise $100 million in a bought deal at a higher price than they were trading for before they bought Marathon, and able to do this gold prepay and just bounce off of all these capital raises to a higher share price. So that's sort of the path that was working let's say 5 years ago, you'd get a Neil Woodyer buying Los Filos from Goldcorp and starting Leagold and then selling it to Equinox after getting into the GDXJ and getting at least a market liquidity event for early shareholders and then a trade sale. That was happening. First Mining Finance getting into the GDXJ, trading hundreds of millions of shares and trading from pennies to $1 plus. Those days seem so long ago now. And to some extent, they engineered, or that process engineered the downfall of the market because, of course, liquidity is ephemeral in mining stocks. Mm-hmm. And so when Keith glued all those projects together to make First Mining Finance and created this interesting book of optionality, there was a market that wanted that and that gave it volume and gave it market cap and got it into the GDXJ. But it didn't last. It didn't last long enough. And all of these companies that made the GDXJ just made it and then got spit out a couple of years or maybe even a couple of quarters later, really fouled that trade up. So if you got your GDXJ liquidity event and then you couldn't sell the company at that elevated valuation, like Gold Standard Ventures as an example, you got in pretty big trouble. And that punished investors in the space. The activists took advantage of that trade for a while, but then couldn't get out of it. And so now we're on to a new market, a new interesting construct. And I'm not sure exactly what the flows will be that will drive this, but since we haven't had any capital flowing into the market for years, I think that some interesting things are about to happen.
With this big move, excuse me, it doesn't seem like it took a whole lot of capital to make it happen.
Yeah, that's
it's not like journalists are coming in. Like, it's mainly like you selling your paper to me.
Those are the best ones, and I think my fondest memory of my long and painful career in trading natural resource stocks was the bull market of 2016. The TSXV bottomed out at 470 in January of 2016 after a long 4-year bear market. And you could see in so many little stocks, especially high-quality stocks, that the sellers had just disappeared. Mm-hmm. And, using Orion as an example, it ended 2015 as a 4.5-cent stock, and it was a 20-cent stock on no news by PDAC. And hey, no one's proud of a 20-cent stock, but going up 4 times in a few months on no news is interesting.
Well,
and that was, and it wasn't
similar to what we're seeing now, right?
Yeah, exactly. And it wasn't just AU. Obviously, there were many companies that had that kind of performance, and it feels to me, and I hate to use that word because that's a cop-out, but I thought we were probably bottoming. I mean, we talked about this at Beaver Creek. It seemed to me we were around 500 on the TSXV then, and we talked about the market having to get small enough to fit into the envelope of capital that was available for it. And I thought at the time, and we discussed this at the time, that we were probably just about there, but maybe a little more pain to come. And certainly we had it. And now it seems like the market got small enough for the capital envelope, smaller than the capital envelope, and now capital is being added to that envelope, and it doesn't take much.
Yeah. You've been through these cycles before. Do you trust this where we're at right now? Or is this more... can you sniff out a bull trap here in the junior resource equities?
No, I think we're on to a new cycle, and I don't think we're in a bull trap.
Okay. I don't think it's a bull trap myself, Dave, but I do have a little bit of a skepticism right now because we've had such a big move, really fast,
as any prudent investor should.
Right.
Trevor.
So and I'll my game plan for the last couple months is there's these just incredibly depleted valuations, good projects, good companies, good management, trading sub $10 million market cap that have some sort of catalyst or on the horizon, or just been so unloved that that risk reward to me is worth deploying some capital. Mm-hmm. And then we get this move, and massive move in the metals prices, good valuations in the equities. But it's happened so fast. I actually, in the last week, have been taking some of my original capital back.
Mm-hmm. Sure.
In playing with house money. Mm-hmm. It's a Rick Rule game. It's a playbook, right? But it's like, so whatever happens, we're talking in the morning in Europe before the U.S. CPI print, which could be a very, very volatile day, because I think you and I both agree that inflation is going to be coming back. Everything we see looks more expensive. Mm-hmm. How the report comes out later today is yet to be seen, but I wouldn't be surprised to see something hotter than expected, and you start actually seeing a correction in the metals prices, because I think it's needed.
Sure.
So I'm just kind of, this is the way I'm looking at the immediate forecast in this market right now.
Right, right. So, and I think we talked about this at dinner the other night. There's been a building crisis on the supply side for almost all commodities. And that's because of these EV mandates, which may or may not make sense depending on your political views. But government policy that drives large capital cycles, those are so powerful, so irresistibly powerful, and so long-lived. And we'll see if Trump gets into office, I suppose, if we continue to need to find another planet made of lithium, or another planet or an asteroid made of copper.
That's right. Mind the asteroids.
Mind the asteroids. But it would seem to me that because government mandates around electrification are so good for everyone in capitalism. It's good for the people who mine stuff. It's good for the people who produce stuff. It's good for the politicians who get to cut ribbons at new factories in their states. It's good for everybody but the taxpayer, potentially, and I don't have a position on that. It may be good for the taxpayer. It may not be good for the taxpayer. It may be good for the planet. It may not be good for the planet. But those policies have resulted in supply bottlenecks across the battery stack. And of course, they've resulted in supply bottlenecks in metallurgical coal and thermal coal and fossil fuels. And so supply-driven bull markets are very, very powerful. And I suppose the one thing that could foul all this up is a change in government policy. But even under Trump, given this is so good for the capitalists, the connected capitalists, I actually don't see that happening. And I could be wrong about that. I don't have tremendous bets on lithium or copper personally. I'm betting on inflation. I think that whenever government policy mandates moving to more expensive goods and services and less efficient energy systems, that inflation is inevitable, and gold has been a cornerstone of that, of the way that I've expressed that view over the years, and remains that way. So that's I don't know that I answered your question there. That was maybe a little more elaborate. And
but I think we were, the question was more or less along the volatility in front of us. Mm-hmm. I mean, after people who have been in these markets long enough understand when jubilation hits, maybe that's a sign that it's gone a little too hot.
Sure. Well, and I guess if you're going to trade illiquid markets, that's a good parameter to include in your decision-making process. I have chosen over my career not to trade illiquid markets because I think that transacting more frequently in these markets has a very high cost. So I prefer to take a view, take positions, and change that view if information emerges that is counter to that view, but stick with it, believing that when you get into the truly powerful bull market in this sector, that the liquidity comes, and then it's a little bit easier to trade. So I probably haven't taken any risk off in the past couple of months. But generally my position sizing is such that I really can only trim it around the margins.
Yeah. Would you say you prefer to hodl your equities?
Well, when you're 10% and on the board, hodling is unfortunately required by law.
It's part of the game. Very good. All right. So moving ahead, I mean, obviously, we're wrapping things up here in Zurich. Any key takeaways that maybe caught your attention in the last 48 hours from these major producers?
Yeah, everybody's still pretty down around the mouth, and
there's no new faces.
Yeah,
I would say.
Yeah.
I mean, it's. You would think at $2,300 gold that there'd be some new people, faces, younger looks, and honestly, I'm just not seeing it. I wonder if that changes in 6 months.
Well, the move in the gold price has been so sudden and so abrupt that it will take a quarter or two for people to see it in cash flows. And I think one of the other things you and I discussed at dinner the other night was the dividend policy of the mid-tier producers and just how dangerous and problematic that has been, and how difficult it is for companies with 4% plus yields to go out and buy growth. And we talked about a couple companies that I won't name, and the problem with them getting bought at billion-dollar valuations now by companies that would then have to spend tens of millions of dollars paying dividends to their shareholders for assets that wouldn't be contributing for a lengthy and unpredictable period of time. And the other beneficial aspect of the gold price moving $300 an ounce in a couple of months is that those dividends aren't such a burden anymore either. And so let's just see what the cash flow looks like at the end of the quarter, and let's see what the cash flow looks like at the end of the next quarter. And I think that if you see a couple of consecutive quarters of really robust cash flow at the producers, you'll see the junior market perform in a pleasing manner.
I mean, the July financials, I mean, that's going to be something worth the patience for.
Couldn't agree more.
Yeah. All right, let's just leave it at that.
Great.
David Lotan, thanks so much. Good to see you, my friend. I always appreciate all your insights, your guidance, and also your time. Thank you.
Thanks so much, Trevor.
All right, everybody, welcome back here into Zurich. We've got a fresh voice and a different perspective here in the gold market. An individual who was up on stage a couple times yesterday, but I actually caught his final panel discussion. He's from Edison Group. He is the Director of Content and Mining, Mr. Charlie Ashbourne. Thanks so much for doing this.
Pleasure. Nice to be here, Trevor.
Yeah. Thank you so much, because it was kind of a big conversation yesterday. They had you up there for almost an hour, it seems like. But I did, I wanted to get, first, let's get basic introductions and, tell us about Edison Group. It sounds like a big service analytical company. You do a lot in mining, and talk about, what they do in general.
That's right. So we write research. We're an independent research provider, which is to say we're a paid-for research provider. Mm-hmm. So for companies, companies will have their broker, and they will have relationships with their clients. They'll write research. It'll go to their clients as per the MiFID requirements. Right. And what we say is, look, if you want to get your story heard further afield, you can come to Edison, you pay us because you put a value on it, we write the research, and then it can be broadcast, as they say, free to air. So literally it can go far and wide. And we can also track who reads it, so it goes up on the platforms, it goes on your Bloombergs, it goes on your Affinitives. Okay. We have a push part where we email people out, and then we track who reads it, who's shown interest, which part of the document. And so, after every piece of research we write, we wait about 6 to 8 weeks, then we compile a readership report. These, we can't say the individual names, but these either private investors or these institutions have been looking at you. So it means if the company then, that's their information. So if they then want to use that when they go on marketing, when they go on road shows. So what it really is trying to do is it's trying to make a distinction between those who are probably already known to you, but then the great unknown. And what we say is we can access those dark pools of capital that maybe you didn't know existed. And we got anecdotal stories where we've written research on I'm thinking of a UK company in particular, and suddenly we had loads of readers in Taunton. Now no one would ever have predicted that in a million years, but it just meant next roadshow they wanted to do around the UK. We said, why don't we take you to Taunton as well? Because we know there are a lot of wealth managers there, and evidently they have clients who are interested. So
very interesting.
Be worth a visit.
Is this all public research?
Well, once it's written, I mean, we will do private research as well.
Okay.
If you want us to do some sort of research into something very specific, and these are usually our existing clients, they will come to us and say, could you please do a bit of research on this is what we'd like you to focus on, and that you will never see in the public domain. But the broad mass of our research goes out into the public domain.
And you get the benefit of writing about mining.
Yes, I do.
Content about mining.
Yeah.
So tell us kind of about what you've seen in the last couple of years. We've gone through a pretty tough market here, inflationary costs, and markets for the most part remove their capital from this sector. With the gold and metals prices moving up, we're starting to see a little bit more interest, I guess, maybe some more capital. I mean, the share prices and valuations are starting to tick back up. But tell me about the last 2.5 years, and how that maybe has changed and how you've treaded those waters.
I mean, I think it's been an extraordinary time. If you look back, a little bit more than 2.5 years. 2.5 years ago, we were mid-COVID, weren't we?
Right.
So if you went back 4 years, we were kind of, at the beginning of it. But gold had actually already made a little bit of a move. I was looking back at something the other day, and I was looking at gold in 2017, 2018, and I knew the price was below 1,500, but I was looking, it was 1,200, and I was thinking, oh my gosh, that's it's not that long ago, and it was $1,200 an ounce. So, but then you got, because the US was tapering and everyone was nervous about what that would do in terms of credit and the knock-on to the real economy, because it was a constraining effect coming from very high up, and then suddenly 2019 is where the gold started to move, because the US suddenly said, look, there are these tensions in the repo market, and so we're going to stop tapering. And I had my ideas of what would happen to the monetary base if that, and it would go flat, and then it would start to rise again. And then suddenly COVID hit, and the gloves, as it were, came off. Massive, another round of quantitative easing, and gold correlates very well with that. One assumes that there's some sort of relationship between the amount of gold there is in the world and the amount of dollars there are in the world. One being a real asset and one being a paper asset. You print loads of paper dollars, you would expect the price to go up in dollar terms. So, and that is precisely what happened. And then there was a little pause about a year and a half ago, where the monetary base seemed to have reached a peak, and the US was talking about reducing it by about 95 billion every month, which they did until about this time last year, and then slowly, very quietly, the monetary base has been growing again. So, and I think everyone's looking at the interest rate cycle, because we had that, during COVID, interest rates were zero, then they got jacked up to 5.25%, and now the Fed for the first time is talking about. And that was because there are inflationary pressures in the economy, and they had to take real interest rates from being negative to being positive, which they've now done. But we're in real interest rates at about positive 2%, but now the Fed is talking about cutting, and if inflation flattens out, then real interest rates are going to go down, and that again is positive for gold. So actually, I think gold has a couple of tailwinds now that it didn't have.
Sure, but also maybe has a few headwinds as well, right? I mean, this interest rate discussion here just boggles my mind. I'm, as a citizen of the U.S., I can see that the Federal Reserve wants to cut interest rates. They're dire to do it. I don't necessarily believe they have the data to justify it.
They might not at the yet. But everyone is looking, the only thing people look at when they're talking about cuts in interest rates is what it's relative to, which is inflation. So if you see inflation go down, get under control, however you want to describe it, then there will be no reason for the Fed not to cut rates. It'd be extremely difficult for them not to cut rates. So I think they could. Now, what's the thing that could derail that? And that is unexpected inflation. And that would be some of that money that's already been pumped into the economy chasing too few goods, and therefore you see that inflation that would be one of the things that stopped it. And the other thing that is certainly a complicating factor is the potential, if some of those treasury auctions, if they start being, if they don't get the demand that they need from investors and they have to drop the price and the yield goes up, that could be a complicating factor as well. So I think, that's one of the reasons I look at real interest rates, not nominal interest rates. Because in my world, if you got 10% interest rates and 10% inflation, it's roughly the same as having 3% interest rates and 3% inflation. Right. So I'm always looking at the gap between the two, not necessarily where they are in absolute terms, and actually not necessarily where they are in relative terms, in the sense that, supposing interest rates went up to 6%, well, would that matter? As far as the gold market is concerned, if inflation went up from 3 where it is at the moment to 6 as well, now to me that would be good for gold. Some other, there are other commentators who think it wouldn't, but I would say that real interest rates are narrowing, because we've got real interest rates at 2% at the moment. But if you went to 6 interest rates and 6 inflation, that would be 0 real interest rate.
Yeah. Well, I mean, gold historically, a lot of people said, "Oh, it's your hedge against inflation." Well, we saw inflation go from basically almost 2% to 9%, and gold almost ran up in 2020 prior, when we were talking about it being transitory.
Yeah.
And it had that move before that big inflationary spike, and then kind of settled as they increased interest rates incredibly fast. I mean, it held in there. I mean, gold definitely held in there. But do you feel that maybe this latest move in the metal in the last 6 weeks may be something that similarly happened in 2020 that move higher prior to inflation going higher?
I think the difficulty, I think it is true that gold is a hedge against inflation. It doesn't necessarily do the hedging at the moment you expect it to do. Yeah, exactly. Right. It can do it earlier. It can also do it later. So it's a difficult one to unpick. That's one of the reasons I look at real interest rates. I don't think the situation is like it was a couple of years ago. I do think it's terribly like it was in the late 70s. And actually one of the things that marked that period out in time was a tremendous amount of volatility in both interest rates and inflation and real interest rates, therefore. And that was actually the moment that gold peaked in, its last great bull run, which is sort of the period 1970 to 1980, when it went up to $850 an ounce in 1980. And that period was marked by exactly the same volatility, and I think we're going to have the same sort of volatility. I think there will be bouts in the next few months where inflation appears unexpectedly and then it goes away again unexpectedly, and I think it's going to be very difficult for the Fed, actually, because I think they're going to be always in a reactive mode, trying to react to something that's moving quite fast and quite unpredictably.
Yeah. Well, if I would have known this conversation was going to happen, I would have held off this interview for another hour and a half, because that's when the CPI print comes out. So who knows what happens here in the next 90 minutes. So you've talked a lot about the correlation between inflation and the metals price, but tell me about that correlation between the fundamentals and the macro with the actual miners. How important has that connection been in the last year or two?
It's a connection that can't be avoided. I think it's a connection that is looked upon with a little bit of uncertainty, maybe even bordering on cynicism by investors, because they've seen this pattern in the past where the gold price goes up, and they think, "Hooray, we're away to the races with our investments." And then what they've seen is that they've also seen costs go up. And quite often they've also seen companies begin to sort of low-grade their resources. So instead of having the mining plan they thought that was being followed, you suddenly see a load of low-grade, and your dollar per ounce figure goes up, and all the margin you thought was going to be there is suddenly not there. So yeah, investors are, I won't say they're skeptical, but it's something they need reassuring on. I think there was a time, and I think you had to go back quite a few years. You probably had to go back to the 90s or maybe even earlier, where investors automatically believed that if the gold price went up, the margins increased. And now I don't think they believe that. They think that if the gold price goes up, margins could increase. But one of the things I need to do is make sure I have my foot in the company management's door to make sure that they stick to the mining plan that I'm expecting them, so I do get those margins, rather than they suddenly start running a load of low-grade material through the plant.
Yeah. Well, we've had a $300+ increase in the gold price pretty quickly. What have costs done in that time? Have those margins expanded?
Well, I think, you say it's pretty quick. It is pretty quick. I mean, it's in the space of 2 quarters. So if you look at company results, you didn't really see it in the quarter to December. So it'll be the quarter to March where we're really looking to see whether we're going to get the results of that move. No companies, to my knowledge, have yet reported their numbers for March, so I don't know. But I think Newmont will be an early one. They always are. Barrick will be pretty early. It'll be a lot of focus, I think, on those companies just to see what's happened to those costs and what's happened to the grades as well.
All right. Well, maybe let's talk about Newmont and what you're seeing, because they were they were getting no love. They did that deal with Newcrest, brought in huge. That was a huge acquisition. The bureaucracy and the overhead of that company, because of that, I mean, their all-in sustaining costs are very high because of all those people and all those layers of administration. But they're also trying to clean it up, and they're trying to divest 6 important projects, or I guess historically have been important projects within the portfolio. I guess they deem it not important enough to where they're ready to get rid of it. And actually, a couple operators, the Eleanor project, Cripple Creek and Victor in Colorado, and I think it goes to say something. So, I mean, do you feel like the Newmont is actually they've taking note of maybe the mistakes they've made in the past, and they're in end of 2023 into Q1, they're making solid efforts to clean that up and take advantage of this rising market?
I think they definitely are. I mean, and they will be thoroughly aware from what their share price has done since they consummated the deal with Newcrest. It hasn't been one of the performers in the sector. In fact, there was a time when it came perilously close, I would have said, to book value. Yeah. So it's gone from a sort of premium rating amongst the majors to arguably a discount among the majors. They will be working very, very hard. They got to get those synergies. They got to get those economies of the scale. I think they can do that in time. One of the things that works against them, it's a big ship that they are now.
Yeah, absolutely.
And they also, so the last quarter, if you looked at their results, a little bit difficult to see through because there were impairments, because you had the other companies, because you had the Newcrest asset coming in, but not for the whole quarter, for part of the quarter. So that all sort of added, if you like, to the smoke and mirrors. They're going to report the first quarter according to one set of not quite one set of accounting principles, but they've said the mines that they're looking to demerge, which are a lot of the ones that you mentioned in North America, the sort of the Eleanors, the CC&Vs. They're going to keep them in the fully consolidated accounts, as I recall, for the first quarter, but then they're going to put them as discontinued operations for the second, third, and fourth quarters. So there's a bit of smoke and mirrors going on there. But this is part of a big redirection, if you like, for Newmont. It's a major acquisition. It's a big redirection. Now, the immediate market reaction was not favourable.
No.
They will know they'll need to get those costs out. It'll take them a while to. The advantage is Newmont, in relative terms, is quite cheap at the moment. So that's your opportunity for investors, I think.
Yeah.
It certainly, if you have faith, if you want to have faith in management, this is what they're going to do, then it's a good starting point.
How much of that deal was based on the needing or wanting the experience of block cave mining that Newcrest had?
I think I wouldn't have said it specifically block caving, but I would have said it. But you're absolutely right in saying that there's going to be a lot more block caving going on in Newmont now than was a year ago going forward. So I think it's not a completely new suite of assets, but it's definitely the discarding old assets and they're bringing in new assets, and amongst the new assets there is a lot more block caving going on. So you can sort of see how they're setting out their stall a little bit as to the sort of deposits that they're going to be interested in for the future, and the sort of size and scale, because those are big deposits almost by their nature.
Yeah, we just had a conversation with Dave Lotan, and we kind of talked about a lot of the torque that's also happening in the mid-tiers. I sat in on the Equinox discussion. Greenstone looks to be getting there pretty dang quickly. Obviously a major project that's going to be operating and cash flowing for them very, very soon. IAM Gold's Kota project, also looks to be good and be transformational for them. Caliber buys the Valentine Project, and so another continued outperformer in the market. So we're seeing these mid-tiers really continue to build out, and we're seeing a lot of activity, which is fortuitous given the timing of the market, I think. But the one thing I've missed in the last 2 days is an investment on exploration. And so maybe you have a little bit of insight. Are these companies from the mid-tiers to the majors prioritizing exploration, or has the market been so bad they just see more opportunity in buying those ounces right away?
I mean, you can certainly buy those ounces very, very cheaply when you're buying exploration ounces in the ground.
Yeah.
I think one of the difficulties in the market at the moment, and you will hear this, I think, from a lot of juniors, is it is still very, the market will fund you 5 million, 10 million here in order to go and do your exploration, even to go and do your studies, take it all the way through to feasibility. But it's when you go to the market at the next stage, of that, the valley of death in the Lotan curve, and say, right, we need the 100 million now in order to develop the project. That's when it becomes very, very difficult. And I think actually the market, there are a lot of people out there saying, if you have a company at exploration stage, it's a lot easier to keep it private, actually, than to go public.
I wholeheartedly agree. I've had conversations with people last 6 months about that.
Yeah,
stay private as long as you can.
Yeah, exactly. And then raise the money, and then maybe that's the moment you go to market. I don't know. I think the market has got to it's got to a bit of a crux in that respect, and something is going to have to give. Now, I'm not quite sure I know which way it's going to give, but I do think something's got to give.
But that's almost like the Canadian way, right? Like, take a project that's had like half a dozen iterations of exploration teams on it. Maybe it has some historic holes, but for the most part, it's moose pasture. So it's an optimistic idea, but that's enough to take a project, create a new company, and take it to the market, right?
Yeah.
And that kind of model has just been, it's done more harm. You could argue it's done more harm than good. If you look at the venture volumes in that chart, it's absolutely abysmal. So why not just keep these things private as long as you can, prove something out? Maybe it is a discovery hole. Maybe it is a small resource. At least you have something tangible to bring to a public market rather than hopes and dreams.
Yeah, and that may very well be the way you might find the market going in two directions, where you have you'll have an entire part of the exploration sector which says keep it private for as long as possible, and ideally try and fund it, get it into production, and then think again. And then you might have the other part of the market, which is the already public part of the market. And once you are public, I think it's quite difficult to go down the private route again. Try and take yourself off. It's not
especially
quite
after a big win.
Yeah, exactly. Difficult. It's kind of a one-way street, and maybe they're fishing in a different pond. And what they have to go to then is the other corporates, the mid-tiers in the sector, the majors in the sector, and actually try and get the funding and the financing there.
Yeah.
Or it's possibly dark pools of capital. But we'll have to find those.
Last question here. I mean, what are you going to be watching through the rest of April? I mean, this has just been an incredible move. Are you expecting some sort of stabilization, pullback?
No, I don't think I am. I mean, certainly not stabilization. I mean, there may be a pullback, but I don't think there will be stabilization. So no, I think we're in a very volatile, moment in the market's history. Would it be April? No, I don't think it would be April. But can I see gold in the reasonably near future hitting 3,000? Yes, I can. Do I think there's an outside chance it could hit 4.5? Yes, I do. It is an outside chance, but those are the sort of gains that we're potentially looking at, I think. So
then we'll talk margins again.
Yeah. Well, at the very least, and a whole load of other things as well. I would have thought.
Right. Okay.
Exciting times, I think.
Charlie, thanks so much. How can people find you? Reach out.
They can find me very easily, via Edison. So my email address is lordashbourne@edisongroup.com. So that, ping me an email or ring the switchboard.
Great.
I'll always get a message one way or another.
Great. Well, I hope we can touch base again here this year.
Look forward to it. Thank you very much.
Glad we could do this. All right, everybody. That's a wrap here from Zurich. We'll be back Monday morning with the morning briefing, plus a lot of other corporate updates that we accomplished with our short few days here at the European Gold Forum. Stay tuned. Be well.